shorting is where you sell or go short an underlying market at a high price. You expect the price to drop, and then you'll buy it back at a low price for a profit. Okay, so traditionally with trading long, you buy low and you sell high, and when you trade short, you sell high and buy low. So the first thing is you sell a number of shares which you don't own at a higher price. Okay, but now how can you own shares that you don't have? Basically, you borrow the shares from a broker or a lender, for example, a market maker. So, okay, so in this case, the seller sells or goes short 200 shares, that is 10 Rand per share, worth 2,000 Rand. Notice the company is COVID limited because we expect the company to crash soon. So the seller sells and goes short 200 shares. After time, the share price drops to 7 Rand. So it's gone from 10 Rand to 7 Rand. You then decide to buy back 200 shares for 1,400 Rand. Okay, so far you've sold them for 2,000 Rand and you bought them back for 1,400. Basically, then, as soon as you buy back those 200 shares, you automatically return the borrowed shares to the broker and you pay them a fee. And you will then pocket the difference. Okay? So the broker gets the shares back, you get the profit, bada bing, bada boom, done. That is how shorting works. Why is it called a short? Where the origin of the short comes from, the first speculation is that normally a bear market or a falling market is very aggressive compared to a bull market. We say that the market moves down a shorter time than when it goes up. And when the markets move up, they move up 70% of the time and they drop 30% of the time. So when you go short, you expect it for a short period of time that the market will go down. The second thing is that they say that the price goes down a shorter value than it can potentially go up. So this is true because generally when you buy a stock or a market, it can only drop to zero, right? So it's a short distance that it can drop. But when the market goes up, it can go up thousands of percents, 10,000s of percents. Why is short selling risky? There is no limit to the amount of money you can lose. A share price, when you buy, can only go down to zero. But a share price can go as high up, and when you are short, you can lose more than what you put in, and you can lose a lot more. The second thing is that when you buy for example, CFDs, based on the underlying share you buy, you will receive the value of the dividends for when they come out. And when you go short, unfortunately, you have to pay the dividends when they come out. You pay the value of the dividends when you short the company's CFDs. And third is that it's risky that sometimes shares aren't available to short due to which depends on your broker. So it's always better to, if you want to be a top shorter, it's always better to have two different trading accounts. Probably not if you've just started trading, but when you've traded for a couple of years, you'll say, you know, I also want to short these companies that my trading account doesn't offer.